Welcome to the Krinzman Property Playbook, where we dive deep into the heart of South Florida's real estate scene. I'm your host, Matthew Krinzman, here to guide you through the strategies, insights, and community connections that make buying and selling real estate a science. If you're looking to move beyond the basics, build trusted relationships, and grow your understanding of this competitive market, you're in the right place. Every episode, I'll be bringing on local pros, from attorneys to contractors, to give you the inside scoop on what it really takes to succeed in real estate. So whether you're an investor, buyer, or just curious about the market, let's kick things off and get you one step closer to your real estate goals. Welcome to the Playbook. Welcome to our podcast today. So I want to introduce you to Brett Swarts. You're what is known as a Deferred Sales Trust expert, and you're a commercial real estate broker, and you're a podcast host. And we'll talk about that. You have an extensive experience helping clients navigate capital gains, solutions, and wealth building strategies. And your company, or you're a founder of the Capital Gains Tax Solutions. Brett has guided high net worth individuals, business owners, and real estate investors through strategic tax deferral plans that preserve their wealth. His expertise spans beyond just the 1031 exchanges. You do estate planning and advanced real estate tax strategies, which I'm really going to want to get into, because this is something I, as a real estate agent and broker for years, am not all that well versed in. I think this is going to help me and help educate my listeners and my friends and clients as well. You're a highly sought after advisor. Seen your videos. I looked you up. There's a ton of you. There's a ton of your info and content out there. And you have your own podcast. It's called Capital Gains Tax Solutions Podcast, and you educate the listeners on innovative wealth building techniques. So we're going to dive into all that. Just want to introduce myself. I'm Matthew Krinzman. I'm a real estate broker associate here in South Florida. I'm with a company called One Sotheby's International Realty. I'm sure you've seen us we're up that way. Your neck of the woods as well, in the St. Augustine, Jacksonville, Ponte Verde area. I've been at this for 26 plus years. I know I look 25, but got shaved this week. So, but I've been doing this for a long time. The podcast is called the Krinzman Property Playbook. So I'm still, growing this. I want to bring in people who can add value to my listeners and also to my friends, family, clients, my sphere, because there's a lot out there in real estate that I know a lot about. I think I like to say I know a lot about real estate, but then there's a lot I don't know about. And I think this is something, what you do is I have an inkling of an idea of what it is. I've been involved in a 1031 exchange here and there, but you go beyond that, right? So
Yes, sir, Matthew. Absolutely. Yep. Yeah. I'd go beyond that. Yes.
So I guess, fill in the blanks for me. You want to tell us a little bit more about yourself, your background, how you got into this, and, educate us.
Yep. So I grew up in real estate in California, helping my parents build single family houses, and about 500 houses my dad built over all the years, and we would help him build. So we learned about sticks and bricks at a young age, learned how to build wealth with real estate, which was really neat. And then I was the second to graduate college on both sides of the family. So more with the brain versus just the arms, and again, the swing and the hammers. I had a chance to study and practice multifamily brokerage at a company called Marcus & Millichap.
Know them well.
And that's where things started to make more sense with numbers and underwriting, and an ability to create wealth through value add, forced appreciation with multifamily properties. And everything was going good for a while until the market crashed in 2008. And that's why friends and clients lose half or all of their wealth. And the main thing we identified was that the 1031 exchange is just really not always your friend. In fact, it can be your worst nightmare if you've overpaid for a property and have too much debt, not enough liquidity or diversification. And so, we were always taught to sell high and buy low.
Of course.
But the 1031 often has you sell high and buy higher in 180 days into a deal that you may or may not have bought if otherwise wasn't for the tax liability.
Right.
We got tired of the tax tail wagging the investment dog, and really clients got hurt. I saw friends, family, and clients lose half or all of their wealth within a couple of year period of time. One gentleman in particular, his name was Steve, and he lost $50 million worth of multifamily property.
How much?
50 million. Yeah. 50 million worth, went bankrupt, ended up getting divorced. And it was really sad to see it all unfold over a few year period of time. And I remember sitting down with him and saying, hey, there's a better way. Or back up. We said, let's sell and get you out of these things. He says, but I can't, I'm trapped. He goes, because if I sell, I'm going to pay the tax. And if I have too much debt, I don't know if I'm going to be able to qualify, and prices are too high. And basically the music was stopping all around him.
Yeah.
And then it was too late, and he was left without the musical chair, and he lost everything. Right. And so fast forward a year after that meeting or so, I learned about a strategy, and this strategy forever changed the trajectory of how we help our clients. And I think it'll change forever the way that people look at 1031 exchanges, because 1031 exchange is blockbuster. And what we have, we believe, is like a Netflix. And this ability allows you to be out of debt. It allows you to be diversified, allows you to be liquid, but it also allows you to go back into real estate at any time. And that's really the big secret here. What if, Matt and your listeners, you could sell high and buy low? All right. What if you could sell high and, maybe buy into some Bitcoin or some stocks or some stuff that makes sense for you at this time, and then buy back into real estate when the market takes a couple of years to turn, because it took 3 years from '08 for the market to turn to all the way to the bottom in 2011.
Absolutely. Yeah.
So it takes time for real estate to turn around, right? And it takes time to the bottom and go back around. And so you've got to be strategic about investing. And our strategy gives you tax deferral, and it gives you the strategic timing to make great decisions. And so that's basically the story. We help people across the country execute on these things. We also do 1031 exchanges. I don't want to say you don't do them. We also do Delaware statutory trust, which is a part of the 1031. But what we really do is what's called a deferred sales trust, which is not a 1031. It's not in the 1031 tax code. It's a separate code. It's called IRC 453, known as the seller carryback. And so we use that part of the tax code structured with the trust. And that's the secret, right? It gives you all kinds of flexibility. And so you become the lender, Matt, on the sale to a trust, and the trust ultimately sells the asset to the buyer. And then you're in a deferral state. This is how it works. And then the money can be invested wherever you want, however you want, whenever you want, basically, as long as it's investment or business purpose, and it can be tax deferred. And that's what our clients love. And then once it clicks, you're like, why would I ever go back to Blockbuster? I have Netflix.
Yeah, well, Blockbuster's wanting the same thing right now. So break. Now this is what you're mentioning. You're talking to me about something that I don't know about, and I would imagine the vast majority of real estate investors don't know about. Real estate people, even financial planners, don't know about. Because I know the 1031. What you mentioned about, you defer the taxes, you have to go buy something again within a certain, you have to identify in a certain amount of time, you have to transact in a certain amount of time. The money is held by the intermediary, 1031 intermediary for a period of time, which is a great gig, by the way. To be a 1031 intermediary is a great gig in the real estate business. And I've come across where like you're talking about, like, I don't have to buy something right now and to avoid the taxes. So you want, I guess, explain to us, let's explain to us, myself especially, and everyone out there, the deferred sales trust. I guess you call it deferred sales trusts. What is, how, the pluses, the minuses, how does it work? How do you put it together? How does an investor put it together? Who do they talk to? All that good stuff.
Sure. And before we get to like the tactical, I want to give one other thought for everybody.
Sure.
Right? What we found over the years, a lot of people want to buy real estate, Matthew, and they have this thought of the financial freedom, right? The rich dad, poor dad, get enough assets to offset and passive income to come in to offset your expenses and be passive. Well, I think that's really step one. And we want to take this to another level and go to truly passive income. And truly passive income, we believe, is passive time and peace of mind, right? No toilets, no trash, no termites, no tenants, no liability. We use the analogy of, if you've ever heard the song by Kenny Chesney, no shoes, no shirt, no problem, right? And he's right. And maybe he's somewhere in Florida, he's strumming his guitar, and he has a nice beverage in his hand, and he's watching the waves lap up on his feet, and he is completely at peace of mind. He doesn't have time, toilets, trash, nothing for that. He doesn't have to worry about rent control or or tenants that are going to not pay on time or anything right? And he's truly just able to live truly passive. Okay. We believe that truly passive income is to your freedom and impact that compounding interest is to your money.
Compounding. Okay.
And when you unlock this, it's a game changer. And there's these baby boomers. There's $84 to $100 trillion of baby boomer wealth that's transferring in the next 15 years. This is known as the largest wealth transfer in the history of the planet. In fact, there's about 10,000 turning 65 every single day in the US alone. And there's about 80 million in the US alone. And 50% of all of the wealth in America is tied to high-end primary homes, businesses, and commercial real estate. Now, all three of those are typically pretty active. If you live in a primary home, it's not active, right? But it's also probably not tapping into the equity. If you have a business, it's active. If you have real estate, it's typically active, okay? So people have, I want everyone to be very clear. I want you to have the big mistake that people make is, I just need to get another apartment complex, or I just need to trade my 25 units for 50 units, or just 50 units for 100 units, or, or I have these 5 houses, I just need to get 20 houses. And you're going, maybe, but maybe there's a better way. Maybe you can sell your highly appreciated assets and get truly passive and compound your cash flow right now and unlock your time. And I'll bring this together for a story. Warren and Catherine had kids a little bit later in life. Now their twin daughters, fast forward, are 10 years old. They own an apartment complex. They've done 1031 exchanges over the years. This apartment complex is worth about 2.5 million. Their NOI is about 120,000. Okay. But what the problem is, and they have good tenants, they have good management, they're fully occupied. It's actually a really nice property and a really nice location in California. Their challenge was Warren was spending time and energy on the weekends, driving through traffic, multiple hours. And he's going, what am I doing? He goes, I had these, it's about $2.5 million worth of equity. And I have these twin daughters at home, and they're 10. And before you know it, they're going to be 18 and out of the house. And we're not spending the time that we want with our kids as much as we want to be able to spend. And so we sit down, we clarify what he wants. He goes, I really want more time and energy and less space of my head to spend over there, and also physical time and traffic. So I said, great, why don't we sell high? Why don't we diversify your wealth? Why don't we increase your cash flow from 120 to 190? But why don't we unlock truly passive income? Remember, truly passive income is peace of mind, right? And basically, multiplied time, right? And so he no longer had traffic. He no longer had time on the weekends away from his family. Now he has more time with his family. And now he has increased NOI and free up his brain space, right? And so that's a really important piece here. What we unlock is really truly passive income. The vehicle that we use to get there is called a deferred sales trust, okay? So it's the tactical, right?
Right.
So we set up a trust before the close of escrow where he sold the asset to the trust. In this scenario, he sold it for 2.5 million and the trust sold it to the buyer.
Okay.
Buyer buys it for 2.5 million. So watch, man, if the trust buys and sells for the same price, it has zero gain, right? So the trust has no tax. Now he received a promissory note back. I think we wrote the note for 9% back to Warren and Catherine. So after closing costs, I think it was around like 2.3 million, 2.35 million or so into the trust. And now you're at 9%. So, 9% is like $211,000 versus 120.
Okay.
So you do there, right? It's over 60, 70% increase on cash. But the biggest thing is it unlocked his time and the energy. And so we just did a regular installment sale with the trust, and the trust sells it to the buyer. Smoke clears, buyer gets title, they're gone, property's gone, and the cash is sitting at Charles Schwab, and it's going to pay them back over time. In this scenario, they're probably going to live off $10,000 to $15,000 a month based upon their needs. That can also fluctuate, right? They can actually turn the income on or turn the income off, which is a big piece of this, because there's certain times when people might move out of New Jersey or New York or California. They might move to a new state like Florida or Nevada or South Dakota. And now they're going to establish new residency there, and they're going to have a lower tax rate as they receive payments. So the mindset shift, Matthew, is going from just a cash flow mindset to a cash flow and tax flow mindset.
Hang on a second. I want to write this one down. This is a good one. Say that one. Repeat that one more time.
We like to say here, capital gains taxes, and it's on my shirt if you're watching this on YouTube.
Tax flow.
We say tax flow, not just cash flow.
I like that. Okay.
And the reason, Matt, is the government has a spending problem. Have you noticed lately?
I've heard some things. I'm not really sure. I hear things. Yeah, I've heard. Yes, I've heard it. Like a drunken sailor. Yes, I believe.
Problem. At this point, it's outright fraud. It's just horrible. But they do give us, good thing about the government. We're thankful. They gave us legal ways to defer and keep the wealth, working into businesses, creating jobs, creating attainable housing, which is really the impact piece of this, right? So I said truly passive income is to your freedom and impact as compounding interest interest is to your money, right? So the freedom and impact starts with your family, right? Warren and Catherine, more time with their twin daughters, less time on the properties, increased cash flow, more travel, but maybe they're going to go on missions trips. Maybe they're going to go serve their community. Maybe they're going to do something they've always dreamed of, right? But also maybe they're going to provide to groups that are building housing in scale. In fact, where we invest mainly is a group that is, on a mission to end the housing crisis in America, right? Now they're starting in North Florida and they have over 20,000 units. They're building another 5,000 units in the next 3 years. And they're continuing to help others do the same thing, build more. So they lend, they build, they buy, and they attainable workforce housing. So they invest. Our funds go from California. They get a bigger cash flow, and they're also providing an impact to provide more housing for the housing crisis, right? So the kind of stuff that we're talking about, if we can shift those mindsets, use the methods of the Deferred Sales Trust, we can multiply freedom and impact for our families, but also for America, people that need housing.
So just so I'm clear on this, so the money gets put into a trust, it's deferred, it's sitting there, it's earning interest. Where is the interest? Where's that interest coming from? From who?
Yeah. So the one place I was talking about, it's this one. We do lending. We do a lending fund. It's a multifamily lending fund.
Okay.
We do a housing. They're buying existing multifamily properties, 300, 400, 500 unit properties. They're building, 300, 400, 500 unit properties. And so that's one group that we work with. We have other groups that are doing land development. Right before it even goes vertical, people can put it into stocks, bonds, mutual funds. We have one client who sold a $17 million billboard company in California, deferred all the tax, and he put a big chunk of it into NVIDIA stock a couple of years ago.
Smart.
And NVIDIA stock is skyrocketed, right? Well, we've had clients. We had a $13 million asset sale, a car wash in San Diego, and they put the money into Bitcoin, right? Yeah. At 40,000 a coin, and it shot up. And they also put it into some hotel conversions, and they put it into some multifamily. And so you can diversify. There's no, S&P 500. I mean, what do you want to go into? We work with financial advisors to
so I like that what you're talking
allocations and different things based upon the risk tolerance of the client. It just kind of, whatever they kind of want to do, we build out a plan and help them execute it.
So you put these people, if someone works through your company, right? Mm-hmm. You have the ability to, I guess, refer them to the financial planners who would say, hey, all right, here, let's take your money, let's invest it, how we diversify that income, that money to earn income. Or they can invest through, you said, a couple other vehicles, through real estate vehicle. Are these JVs or are these partnerships that you
can
create?
Be both. So you can be an entrepreneur or you can be passive, right? And so we have very entrepreneur clients, because some people say, hey, I want control. I want to be able to run my own capital. I don't want to give it up to a financial advisor. I don't want to go into the stock market, or I don't want a third-party passive real estate group. I want to do it myself. I made all the money myself. Can I do it myself? And the answer is yes. So like Warren and Catherine's a great example. I mean, they're in their early 50s, mid 50s. But guess what? Once their kids are 18 and out of the house, Warren might want to, and Catherine might want to go buy a property, do a deal.
Sure.
That's the beauty. You can partner with the trust and you can run your own deals. So you can buy real estate again, be active again. You all tax deferred. You can start a business. Let's say their daughter graduates college at 22 and wants to start a business. Guess what? The trust can be the funding source for that new business venture. So this is like so much bigger than just, sell, do a 1031, do the same.
Or pay the capital gains.
Which, by the way, businesses don't work for 1031. We've done this with Bitcoin exits. Bitcoin doesn't work for 1031. We've done it with primary homes. Does not work for 1031. Ours works for stock.
Life insurance. Can you do with life insurance policies?
Yeah. So life insurance is typically already after tax, right?
Right.
So you sell something, you pay your tax, you put it in there, and then you get a big payout at death. So, and the death, it's tax-free, right? So there's no point on doing that for life insurance. So so ours would be, if you have a big taxable event, it's somewhere between 20, 30, 40, 50% of your proceeds are going to be taxed depending on where you live and what depreciation recapture you have. So, like Florida would be like 24% because there's no state, cap gains tax. But like California would be, 13.3 plus 20 plus 3.8 Obamacare. So you're like at 37 minimum, right? Jeez. Plus depreciation recapture. So we did a deal in Colorado where he was like a C Corp and he was going to pay something like 45 or 48% because of the C Corp nature of it. We were able to defer all of those taxes. So those are just some of the examples that we're using.
At any point, the people are in this deferred sales trusts. At any point, are they ever subject to capital gains tax or ordinary tax?
Yeah, they are once, and if they dip into the principal.
Okay.
But the reality is, Matthew, 99% of our clients aren't dipping into the principal.
Very
So we'll use
interesting.
an example. We just did an $8 million deal up in Massachusetts. It was an automotive sale. Really cool couple. They bought the business a number of years back from a gentleman who's retiring. The revenue is about 100,000. They drove the revenue to multiple millions of dollars. So they sold it for $8 million. They deferred over $2 million of tax using our structure. They unlocked truly passive income, which was awesome, right? But here's the reality. They're only taking interest payments.
Ah,
Okay. So they let the full amount stay in the trust, principal, invest it. They live off the interest. Now they only pay tax on the interest payments. It's ordinary income tax on that.
yeah.
But they're happy. They're like, oh, this is incredible. We can keep this for our whole life and pass it to our kids and just keep it going. And the answer is yes and yes. So that's how that works.
Got it. What other vehicles can you use this for? I mean, you mentioned, let's say I have let's say, okay, I don't have a real estate portfolio, but I have a ton of NVIDIA stock that I've made. It's split, and now it's time for me to sell. I've held it, now for 4 years, and I'm going to be subject to capital gains on this. How can I take that sale, those stocks, and use it as a deferred sales trust?
Yeah. So the first thing is understand, so if I'm selling NVIDIA stock and I have a huge gain, you can use the deferred sales trust plus to defer that capital gains tax as long as it's $1 million net proceeds, $1 million gain. So it needs to be a large gain on the NVIDIA stock. But yeah, we can absolutely lose it for NVIDIA stock. We'd set up the trust. And the trust you transfer the stock to the trust, and the trust would issue a promissory note, and then the trust would sell the stock on the open market to cash, and then the cash would hit like a Schwab account, and then the trust would slowly pay you back over time. And since the trust bought and sold the NVIDIA stock for the same price, the trust has no gain. And since you're taking back in installments, you're only paying tax slowly over time.
Interest.
So yeah, so it works for stock, works for Bitcoin, works for business, but this is a great way to exit NVIDIA stock.
And those who are fortunate enough, who made that, who bought it, I guess you want to say like 2020 at some point, during COVID, and then have ridden it all the way up. It's up and down now, but if you got the split, you're still way ahead of what you paid for it in 2020, say April 2020, when it was it was not even $100 a share at that point yet. Right. So then what rode up to like 700 or so, and now it's split. Right. So now you're it's trading around 130, 131, 140. It just depends on the day when something comes out of China, some AI that's supposed to blow it, make NVIDIA chips obsolete, which then we find out 2 days later, no, it's not happening. That's not going to be the case. So we're talking about deferred sales trust, 1031 exchange versus deferred sales trust. What if I just say, I don't want to do the deferred sales trust. Let's just do the 1031 at this point. How do you work with that, with people like that?
Yeah, so we have the best 1031 exit plan, right? So if you're going to consider 1031 exchange, you want to use our best 1031 exit plan to give you both options, a regular 1031 and a backup plan in case the 1031 fails. And how that works is we do use a regular QI company, but we've put specific language into the contract that gives the ability for you to basically take an exit ramp before the deal, the 1031 ends on day 46 or day 181.
Right.
And that way you can leverage the trust as a backup plan to not overpay for a property. Also, sometimes we do a 1031 and a deferred sales trust in the same deal. So it's not always a one size fits all. You might sell a $10 million property, have a perfect $6 million exchange lined up. You do that $6 million and the other $4 million goes into the deferred sales trust. And so the best 1031 exit plan gives you both options to make great decisions based upon the property you really want to buy. And the remainder can be in a deferral state with your powder dry, ready to go.
Gotcha. Because that's actually a good idea when you talk about an exit ramp for that. Because I imagine what a lot of people who have owned commercial property or any other type of real estate, and they're like, all right, I've had it for 10 years, 20 years. I'm going to have this 1031 exchange. I got to find something equal or more. I can never go. It's interesting. You can't do the step down. You can't buy something for less. But that's the way the code is written. We'll deal with it. I'm mostly a residential broker. But there's always overlap, right, between the residential and commercial, because someone's going to ask me. That's always going to happen. Where you see an issue now where the valuations have gone so high over the last few years that, wait a second, I'm selling my property. I'm selling this let's say multifamily, 20 units for $4 million. And if I want to go buy something that has kind of the equal, the cash flow that I was getting with those 20 units, now I got to buy something for $8 million and the cash flow is not there. And because it just now, but now they're buying, it's like, almost seems like you're not benefiting from this now. Because it used to be like, oh, okay, great, I can keep on stepping up into my real estate. But now it seems like even if I'm buying and selling for $4 million, that $8 million cash flow is not, it's not the same as I was getting. It was that $4 million, and I'm actually still getting the same amount of units, but I just have to defer my taxes somehow. So that's what you're talking about, an exit ramp to avoid that. I guess it's so someone gets like, oh no, I can't do anything here. I can't get out of here.
You got to be really clear on what you want, right? Like, what's the purpose of your capital and your time and your energy in that apartment complex? And could you unlock truly passive income if you sold it and used the deferred sales trust? Or are you going to be in the same thing? I had one client, he had 18 units in Sacramento, and he was going through, his name is Peter, and he was living in Marin, California, driving back and forth. He's actually a real estate broker himself, had multiple assets in the Bay Area, and happened to have this one deal that was kind of an outlier that took him a couple hours to get to in traffic back and forth. Same concept. He's driving, C neighborhood. He had 1031, thought he got a good deal on it. To find out, he's like, what am I doing? He's inside of the unit helping a tenant, and there's a drive-by shooting, and his truck gets shot, and he's like, what am I doing? He's like, I don't need this. And so I said to him, Peter, and I was kind of being facetious. I said, Peter, but why don't you just do a 1031 exchange, And he goes, Brett, I have 18 problems. Because I don't need 36 problems.
I don't need 36.
I don't need 36 problems. I already have 18. He goes, get rid of these problems. So we sold. He paid off all of his debt, got rid of all 18 problems. He unlocked truly passive income, right? And so that's really what people are looking for. Again, truly passive income is to your freedom and impact as compounding interest is to your money. And so the steps are just get really, really clear on what you want and what matters the most to you. And then it gets really simple. You go, okay, well, if I had 30,000 passive per month, then I didn't have to do anything. Well, yeah, that's what I really want.
No drive-bys.
No drive-bys, no tenants, no toilets, no trash, no termites, no rent control, no nonsense anymore, right? And this is what once people see that it doesn't have to be this grind of you own it all yourself, do it all yourself. If you want to get back in the game, go do it. You find a great deal, boom, you can jump right into it. So you can still be that entrepreneur. You can still be that hands-on investor if you want to, but you don't have to. And that's the beauty with the deferred sales trust.
That's what when I personally, when I have a client or, a friend or a family member, and it's like, I'd like to buy, get into the real estate, which is great. Look, real estate is a great wealth builder. It builds generational wealth. It's proven throughout history that the greatest wealth that's been created is through owning and buying and selling real estate throughout the millennia, really since the first deal was ever made, right? But it's not made. But then being a landlord is not for everyone, like you said. And obviously, I always tell them, like, hey, before you do this, let's understand something. You're going to be the landlord. If you don't have a property manager and you're going to do it yourself, prepare for a phone call at 3:00 in the morning from a tenant, toilet backed up, and not everyone wants to do that. And but then again, you can go into other fields. You don't have to be just a multifamily owner. You can be own warehouses in a triple net lease and not ever have to worry about that, or own a Dollar General and basically clip a coupon every month from them.
Let's talk for a second, right? So these triple net, these deals are some of the worst I've seen, right? Just sell your cash flowing cow, and you're done with the toilets, trash, termites, active management, and go into a single tenant asset, right? They do all of the taxes and insurance and the maintenance or whatever. So in that sense, it's peace of mind.
Sure.
But these things go vacant. I mean, we had this Walgreens that
I see that a lot now.
California, next to the top freeway and top neighborhood, and the thing goes dark, right? And it's a whole Halloween store. And you're just like, what? What are you doing? Why would you put all of your money into one deal? And they guarantee the lease and they keep paying it, but okay, well, eventually that lease is going to run out,
and your assets worth.
And now you're stuck with the vacant building. And so this is why not sell, diversify, and go into some mobile home park fund, a multifamily fund. If you want to go into a Walgreens fund, go into a Walgreens fund, right? Where it has 100 Walgreens, right? That you can diversify across. And so this whole idea of just 1031 and deal a single asset, that's single tenant, just because it's triple net, it's just very risky. I just don't think it's worth the trouble when it comes to that. It's not worth the sleepless nights if something might go out. This is where, the deferred sales trust just completely takes that out. That's an old Blockbuster method. And so we like Netflix. Yeah.
Yeah, it's all about the streaming now. It's all that. So we talked about deferred 1031 versus deferred sales trust, maximizing the profits in your real estate sales, wealth preservation. Now, the future tax planning for this, how does that work? What do we do?
Well, when we say future tax plan, it's kind of vague, right? So
Uh-huh.
are you looking at estate tax or death tax? We can eliminate the death tax, which is really powerful for very large net worth individuals worth more than 20 million and 30 million plus. We can eliminate estate tax by selling it into the DST 2.0. And that's a big thing because the stepped up basis is not solved for the death tax. It's understand, like we've been taught 1031 and swap until you drop and die, you get a stepped up basis and you're tax free. No, your kids are only capital gains tax free at that point. They're not estate tax free, which is the government's biggest mousetrap, which is 40% above the exemption amounts. And so,
just ridiculous.
Here's the mistake: is thinking that you're tax free. The mindset shift is looking at estate and death tax, right? Understanding the exemptions and the amounts. And then the method is using the DST plus to eliminate as you sell these assets into the trust while you're still alive. And then your children can be the beneficiaries and they can inherit estate tax free. So that is something that's really powerful. No charity, no life insurance, no gifting required, which is very hard to find.
Yeah.
And so, our strategy goes back thousands of transactions, over 28-year track record, and been through over about 30 audits, all no change, no findings. We provide lifetime audit defense with the tax attorneys. So these are all the things that are very attractive for why you would use the DST over a lot of these other strategies.
So you just mentioned, about the estate taxes or death taxes, whatever you want to call it, probate, things like that. So we hear irrevocable trust, family trust, things that are put into a trust. How is the deferred sales trust different from those? Or are they kind of like overlap?
Trust. There's the irrevocable trust, there's revocable trust, and there's business trust.
Right.
And there's, even within all those trusts, there's different mechanisms for why you would use each trust. The irrevocable trust is used typically, or revocable trust is used typically for probate avoidance.
Yeah.
So you want to pass your assets to your kids and not have to go through the courts. Okay, so that's a living trust, right? It's usually typically what it's known as. The deferred sales trust is a business trust. It owes you the money. So the asset you have is a promissory note. Therefore, the promissory note goes inside of that living trust, and your kids can step into your shoes and keep it going, right? Keep it tax deferred.
So the deferred sales it's a business. You're giving it to the business is holding it, basically. And the business is paying you.
That's holding the assets. It owes you back the money. Yep.
Got it. Great. Wow, this is a lot. It's a lot to take in and understand. Not because if you don't know about, if you've never heard about this, it's like, well, this is mind blowing. Because and I always try to tell people, it's like, look, real estate has so many different avenues to make money and to create wealth for yourself and your family beyond, right? And then there's all these different strategies that, like most real estate agents, no, not most. 99.9% of all real estate agents, professionals that we like to call ourselves, don't know anything about these things. And, when I hear about this, and I think I like to say that I had some experience or I had some knowledge, because I come from a background like you. My whole family's in real estate. I grew up in it. Miami, South Florida, you either became an attorney or you went into real estate. That was kind of where you went. My brothers became attorneys. I went to the real estate side, went to sales. They are real estate attorneys. My father was a broker, things like that, and been here, and he did some building at some point as well. So it's kind of like in our blood, but you don't learn. No one teaches you these things necessarily. You have to go seek it out. And that's why, someone like you, at a meeting today, we're talking about this, like, oh, this is mind blowing. Because I think, I'm around people who are savvy, but I never hear them mention these things. And because they don't know, or they're happy with what they're doing, as far as their business goes and in real estate and in investing. And they're willing to do the 1031s or pay the capital gains, depending on how long they've owned the property, things like that. Or they keep it in, the family trust or things like that. But what you're saying is, like, what really strikes me is creating the passive income and passive time, And as we get older, those of us who are getting closer to that age where do I still want to be chasing deals when I'm 65. I want to kind of, that whole idea of sitting on the beach with my barefoot in the sand with a margarita in my hand really sounds very appealing. Actually, it sounds appealing now. It sounds now very appealing. My birthday is next week. So I'm like, yeah, maybe I'm getting to that point too. But the more knowledge we're able to bring and information that we're able to impart to people, it just makes, I think it makes our business better. And that's why I'm enjoying, like this podcast and meeting people like yourself who are in different facets of the real estate business is great for me. And I think it's great for everyone else, because now it's like, I knew about this. I didn't really know about it. Now I learned, thanks to Brett, I know more. Or I have someone I can say, pick up the phone or send an email to and say, hey, Brett, I got these clients. They got 20 units. They want to get out, but they don't want to do a 1031. How can we help them? And I think that's really what we're here to help. I mean, I think real estate people get a bad name, I think, in some ways, like, we just care about the next deal. No, I think we really care about helping the people we're in business with, our clients, our friends, our family, our sphere. We want to help them build wealth. It's just not beyond selling the house. It's creating the relationship, right? And help looking out for everyone.
Absolutely.
So, this is great. I mean, so let's tie this up into a neat bow. Give me the final bullet points, things that where if I'm having a conversation with someone or someone who's listening to this or watching this, hopefully in the next couple of weeks, once we get this up, where, how the finer points, things that they should be looking out for, thinking about.
Here's the action steps, right? Actions are this, like an ROE analysis on your entire portfolio, right? What's your return on equity? Yeah. And then do an ROT analysis. What's your return on your time, right? And those two analysis, that'll give you some data points to be able to look at, okay, well, I'm spending X amount of hours per week on average, and this particular real estate asset is returning $120,000. Let's just say net operating income after everything. Okay, great. And the asset is worth $3 million. All right, and so you take the 130 or 120, 130 divided by the 3 million or so minus the closing cost, but just to keep it simple, that's going to give you a number, right? And then you say, okay, if I were to sell and then move all of the net proceeds into something like the Deferred Sales Trust, what can my cash on cash return be? We're typically returning 8, 9, 10% net of our fees every year, compounding year in and year out, right? So, okay, I could do that versus where I'm at. What does that look like? And then the next step would be, how quickly can I sell? I mean, this happens all the time. People go, oh, wow, I do my ROT, I'm spending X amount of hours. I do my ROE, here's my return on equity. And how quickly can I sell? Like, this is a no-brainer. And they come and they sell, and they don't sell until they have this solved for. Of course, we can defer all capital gains tax. That's a big piece of it too. You'd figure out your basis. You'd figure out what you're going to sell for, right? We do the difference between those. You get a gain. You do a tax rate to that, depending on what state you're in. But generally speaking, you're going to have an extra 20, 30, 40, 50% more proceeds using our structure. And then you can diversify that and invest it and live truly passive income. So those are the action steps. If you're like, Brett, that's a lot. Okay, we'll start with the book. We have the book. A capital gains tax exit plan. It's on Amazon. You can pick it up. We have Kevin Harrington from Shark Tank in the book, which is pretty cool. And this book right here is the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or for your clients. And so if you're a real estate agent like Matthew and you want to get that luxury listing or that real estate listing, this is a book that you want to pick up because it can give you that listing opportunity, and you can start handing these out to your clients and they can read it and they go, oh my gosh. So we have actual deal stories in here of clients. We have the full breakdown, how it works, the track record, the legal part of it. We have amazing people that have used the structure, and amazing advisors in here that are also a part of our inner circle team. So that's all there on the book. And all of this, if you want to get started, is at capitalgainstaxsolutions.com, where you can get started and you can apply for a one-on-one consultation call, no cost, no obligation, as long as you have at least $1 million net proceeds and $1 million gain on a potential sale. Okay. We do need to set this up prior to the close of escrow. Okay. So you need to get with us early, right? Get with us early, and we can start mapping this all out. And the last thing I'll say is brettswarts.com has all of my social media, YouTube channel, everything I just talked about, including the best 1031 exit plan. It's all right there at brettswarts.com.
Well, by the way, one big takeaway I just got from you was ROT, return on time. That is, I've been saying that a lot lately, not necessarily return on time. It says, look, I don't mind. I can make back the money. It's the time I can't get back.
Correct.
And I've been using that a lot lately. And now, but you just gave me this ROT. I'm going to now I'm going to steal that from you. I'm just letting you know upright. So if you have a copywriter on that, I'll send you a check every time I say it.
One more too. Ready? Most people think
Sure.
ROI, return on investment, Matthew. You know what the better ROI is?
What is it?
Return on impact.
Return on impact. Okay. Return
And that's
on
the big
impact.
thing, right? To wrap all of this up, I think in another bow is you got to have family, mission, vision, values really clearly laid out. And when you do, the wealth plan and planning and strategic part of it becomes much easier because you have a kind of a true north for how you're going with that, right? Wealth and financial independence and kind of things you can do, a lot of number stuff. But if you don't have that true big purpose around it to move it to the next generation,
Sure.
then you can get stagnant there, right? So be aware of that. You really need family, mission, vision, values. You need ROI, return on investment, but really the other ROI.
That's powerful. That's good stuff. I love that. The ROT, that's going to be my motto from now on. Yeah. I'm going to live by that one. It's like, what's my ROT? Yeah. Like, what do you mean? Are you talking about return on investment? No, investment's fine. I got the money.
Yeah.
The time that I don't have. So I have it for today. So this was great. I really appreciate taking the time, Brett, to help educate myself, people who will be listening, my sphere, my friends, my family, because the more we are able to get knowledge out there and other vehicles and other ways to build the wealth and preserve the wealth, most importantly, preserve the wealth and income and create income, the better off I think we all are. And then you have the return on time and you have the return on impact. All those things will come together for you and for anyone else. So this was great. I learned a lot. I hope to learn more from you at some point, learn more about it. And, obviously, hopefully we can work together or we can learn more about how we can impact each other, and help each other on our return on time. And, I thank you for the time. Thank you very much, Brett. And let's keep in touch and keep the communication open.
Absolutely. Thank you, Matthew. God bless you guys.
Yeah. Thank you. Have a great day.
That's it for today's episode of the Krinzman Property Playbook. I hope you've gained some valuable insights and feel inspired to take your next steps in the real estate game. If you're ready to make a move or need expert guidance, let's connect. Whether you're buying, selling, or looking to invest, I'm here to help you navigate the South Florida market with confidence. You can reach out to me directly through my website or on social media. Let's get the conversation started and make your real estate goals a reality. Thanks for tuning in, and I'll see you next time on the Krinzman Property Playbook.